question number 2, part A. Not number 2, but number 4. Sorry, question 4, part A. So the November 2020 question number 4, part A, it reads that Yolanda Engineering Works, Yolanda Engineering Works is contemplating the purchase of a new machine to replace the existing one. Existing machine was purchased 2 years ago at an installed price, replaced at an installed cost of 500,000. So the machine was estimated to have an economic life of 5 years with the nil salvage value. But critical analysis of its performance now shows that it is usable for the next 5 years with a resale value of 100,000. The current disposal value of the existing machine is 200,000. The new machine will cost 600,000 and requires 50,000 in the installation cost. Since the machine is not locally available, the company plans to import it and will pay import duty and freight charges of 150,000 and 100,000 respectively. The new machine shall require an overhaul at the end of the 3rd year, which is expected to cost shillings 100,000. Overhaul cost is to be amortized on a straight-line basis over the remaining useful life of the machine. So to support the increased business resulting from the purchase of the new machine, accounts receivable will increase by 250,000. Inventories and accounts payable shall increase by 200,000 and 300,000 respectively. At the end of the 5 years, the new machine will be sold for 250,000. The estimated profit before depreciation and tax over the next 5 years period for both machines are given as follows. So they have given you year 1, 2, 3, 4, and 5. They have also given you existing machine, new machine. So additional information, note number 1, the corporation tax rate is 30%. The company will use the straight line method of depreciation. Note number 3, the cost of capital is 13%. Capital gains are tax exempt. Now required, Roman letter 1, incremental initial cash outflow. Incremental initial cash outflow. Roman letter 2, the incremental net operating cash flows associated with the proposed machine replacement. Roman letter 3, should existing machine be replaced? They want you to justify your answer. So we start off with the Roman letter 1. We start off with the Roman letter 1. Roman letter 1 is meant to be the incremental initial cash outflow. That is the same as the step number 1. It is the same as the step 1 of dealing with the replacement analysis. It's the same as the step number 1 of dealing with the replacement analysis. Of dealing with the replacement analysis. So incremental cash outflow. The incremental cash outflow. So that is now meant to be our step number 1. That is now meant to be our step number 1. So in that particular step number 1, we shall start off with So there are some items there. We normally start with the initial cost of the new machine. We normally start with. So this one, they gave you the purchase price. The question had given you the purchase price of the new machine. So you are given the purchase price of the new machine. So are you able to see what they say that? Where they say that the new machine will cost 600,000. So the initial cost of the new machine, initial cost of the new machine, initial cost of the new asset. So initial cost of the new asset, initial cost of the new asset is meant to be 600,000. It's meant to be 600,000. It's meant to be the 600,000. Then we are supposed to add the installation cost. So the question had given me something about the installation cost. The question had given me something brief there about the installation cost. So how much is the figure for the installation cost? So installation cost was given and it is meant to be 50,000. Is it 50,000? Yeah, so it requires 50,000 for installation and the amount will be recorded there as 50,000. Then apart from that, they say that the machine was not locally available. So they had to make some cost to import it. So in the question, there is import duty. We also add import duty. So import duty is meant to be 150,000. Import duty is meant to be 150,000. The next one should be the freight charges. The next one should be the freight charges. The freight charges. The freight charges. So freight charges, they gave us how much? So they were able to give you 100,000. So first, you add them together to get the total initial cost. We shall first of all add them together to get the total initial cost. So to come up with the total initial costs, so that we get the total initial cost. So what is the total initial cost? Sorry? 900,000. Yes, 900,000. But we are supposed to add changes in the working capital. We add changes in the working capital. Changes in the working capital. The changes in the working capital. So what is the changes in the working capital? So to get the changes in the working capital, the question had said to support the increased business resulting from purchase of the new machine. Account receivable will increase by 250,000, inventories and accounts payable increase by 200 and 300. So you take 250,000 plus 200, then we minus 300 like that. So 250 plus 400 minus 300. So that will be able to give you what is supposed to be the working capital. It is how much? 150. This is 250 plus 200. Then we minus 300. Yeah. So it is 150. It is meant to be 150,000. Then we shall also be required to add. We shall also be required to add their overall costs. also going to add the overhaul costs. But overhaul cost, we discussed something about overhaul when we are doing the NP, isn't it? Fanya net present about to find sorry for an overhaul cost. I remember when we did NPV, those who are online, did I explain something on the overhaul costs? Those who are online, kindly let me understand whether you remember we discussed something on the overhaul cost, isn't it? Yeah, there is a question we did under the net present value, and I gave you some notes on the overhaul costs. So overhaul cost will also be included when you get the incremental cash outflow. But now when you go through the question, overhaul costs were not incurred in year 0. Overhaul at the end of the 3rd year. So when it occur in the 3rd year, we need to get its present value. So the overhaul cost is meant to be. So overhaul cost is meant to be the 100,000. 100, but we discount it because it was not incurred in year 0. So 100,000, then present value interest factor. The cost of capital was given as 13%. So it was incurred at the end of the 3rd year. So it should be 13% in year 3. So 100,000. So confirm in the table. What is meant to be 13% in year 3? It should be 0.6931. 0.69. So when you multiply that figure, it should be able to give you 69,310. 69,310. Then we are supposed to less market value of the old asset. Market value of the old asset. So when you check through the question, you are given something brief concerning the current disposal value of the existing machine is supposed to be 200,000. Like that. So you subtract that so that you get the gross cash outflow. The gross cash outflow. So that we come up with the gross cash outflow. Sorry. It is coming to which figure? Sorry? 919. 310 like that.
Yes.
So online you are getting that figure. Sorry for the delay. 919,310. Then after the gross cash outflow, we are supposed to add tax on the capital gain. We are supposed to add tax on the capital gain. Tax on the capital gain. We are supposed to add tax on the capital gain. So when it comes to the tax on the capital gain, when it comes on the tax on the capital gain, so we normally start with market value. Market value of the old asset. Market value of the old asset, which is supposed to be 200,000. This figure. Then we are supposed to less net book value of the old asset. The net book value of the old asset. Net book value of the old asset. So when it comes to the net book value of the old asset, it comes to the net book value of the old asset, we start with the initial cost of the old asset. The initial cost of the old asset. So when it comes to the initial cost of the old asset, you can see in the first paragraph, the existing machine was purchased 2 years ago at an installed cost of how much? 500,000. So the machine was estimated to have an economic life of how many years? 5 years with the nil salvage value. So we take the 500,000, we subtract depreciation. We subtract depreciation for the last 2 years. So depreciation will be given by 500,000 minus the salvage value. Minus the salvage value, it was 0. It was supposed to be there for 5 years. We divide by 5 to give us depreciation per year, but multiply again by 2. Multiply again by 2 to get the net book value of the old asset. To get the net book value of the old asset. Get the net book value of the old asset. To get the net book value of the old asset. So how much will be that net book value? Because this is the depreciation per year, but has been there for 2 years, multiply by 2. Then subtract it from that to get the net book value, which is how much? So what should be that net book value? When you subtract this figure from the 500, you are getting which value? Online, you are getting which figure? Anyone who has calculated? Because I'm relying mostly on you people for confirmation. So they are saying 300,000. So we minus the 300,000. But now this one is a capital loss. This one is a capital loss. It is capital loss. So when it is a capital loss, we ignore anything in the form of the capital loss, so that we come up with the incremental annual cash outflows. So we ignore. When it is a loss, we ignore. But if it is a gain, multiplied by the tax rate before you add it. we multiply by the tax rate for add the value. So that is now our Roman letter 1, which is the same as the step 1, which is the same as the step number 1. So after our step number 1, we got the step number 2, which is our incremental depreciation per annum. We now calculate the incremental depreciation per annum. Now compute what is meant to be the incremental depreciation per annum. Now calculate the incremental depreciation per annum. Now compute the incremental depreciation per annum. So to get the incremental depreciation, per annum, get the incremental depreciation per annum. So incremental depreciation per annum, because of their overhaul, I will separate them. So there will be one from year 1 up to year 3. Because overhaul was incurred at the end of the 3rd year. Then now there will also be year 4 up to year 5. I'm separating them because of the overhaul. I'm separating them because of overhaul. So the first item there, should be going to be, we start with the new asset depreciation of the new asset. We start off with the depreciation of the new asset. So for the depreciation of the new asset, it should be, we start with the initial cost. We start off with the one for the initial cost. We start off with the one for the initial cost. So that initial cost, you can see the one for the new machine. We calculated total initial cost in the step number 1. You can see the 900,000. And that is what we depreciate. That is what we should be required to depreciate. Then we are supposed to less the salvage value. So they had said that in the last paragraph, at the end of the 5 years, the new machine will be sold for how much? 250,000. Consider 250,000 somewhere. Sorry, nothing to happen. Yeah, 250,000. It's meant to be 250,000. You have seen it in the last paragraph before your year 1 and up to year 4. They have said at the end of the 5 years, the new machine will be sold for how much? 250. So now you have 250,000. Yeah, so we divide by the 5 years. We divide by the 5 years so that we get the depreciation per annum. So that we come up with the depreciation per annum. Come up with the depreciation per annum. So how much is it every year depreciation? Sorry? So you get 130,000 online. Yeah, that's it. So every year, from year 1 up to year 3, every year, year 1 up to year 3, it is 130,000. Also, every year from year 4 up to year 5, it's also 1, because it is on a step like this. So every year, you have those years. every year. We have those figures. Then there is also, apart from the initial cost, there is another one of the overhaul cost. That is the one for the overhaul cost. So overhaul costs are normally amortized or depreciated over the remaining economic life of the asset. Over the remaining economic life of the asset. So overhaul cost is to be amortized on the straight line basis over the remaining economic life. So that amount was 300,000, but was incurred at the end of year 3. So we take that figure of the 100,000, divide by the remaining economic life. So a remaining economic life is 2 years. So when you take 100,000 divided by 2, we shall get the value for that. So year 1 up to year 0 is 0. But now year 4 and year 5 each year should be given each year. It will be 50,000. So that when you add them, you get the total depreciation for each. So we get total depreciation. So this should be 130,000. This one should be 180,000. Should be 180,000. So we less depreciation for the old assets. We less depreciation of the old assets. Less depreciation of the old assets. Less depreciation of the old assets. So to get depreciation of the old asset, you remember the net book value of 300,000 after 2 years. So you remember we got a net book value of 300,000. Then they had said that after critical analysis of its performance, now it shows that it is usable for the next 5 years with a resale value of 100,000. A resale value of 100,000. But we depreciate it also for the remaining 5 years because that is what they stated. That after the critical analysis of its performance, now it's just that it is usable for the next 5 years. With a resale value of 100,000. So divide by 5 years and see how much will be the depreciation each year. So that will be 40,000. So this should be 40,000 every year for the 5 years. That have a plot at 40,000. So when we subtract, we shall be able to get the incremental depreciation. We shall get the incremental depreciation per annum. We shall be able to get the incremental depreciation per annum. We shall be able to come up with the incremental depreciation per annum. So how much is it for year 1 to 3? 90,000. I ain't giving me 140. So that is now what will be our depreciation for the two for the 2 periods. The one for year 1 up to year 3, year 4 also up to year 5. Then we go to the step number 3. Step number 3, remember it was the incremental salvage value. We got the step number 3. We have only answered Roman letter 1, which was our step number 1. So we still have those other steps. So step number 3, we get the incremental salvage value. We get the incremental salvage value. We get the incremental salvage value. So we need to come up with the incremental salvage value. Incremental salvage value. Get the incremental salvage value. So when it comes to the incremental salvage value, we start with salvage value of the new asset. Start off with the salvage value of the asset. Start off with salvage value of the new asset. Remember, it was 200 and what? Remember 250,000? Yeah. Then we less the salvage value. We less salvage value of the old asset minus the salvage value of the old asset. So this one is 100,000. When we subtract, we get the incremental salvage value. When we subtract, we get the incremental salvage value. We get the incremental salvage value. The incremental salvage value. So that is now our step number 3. We now got the step number 4. So step 4 is the same as now our Roman letter 2 of the question. Step 4 is the same as the Roman letter 2 of the question, where they were asking you to calculate the incremental net operating cash flows associated with the proposed machine replacement. So to get the incremental annual cash inflows, so when you want to compute the incremental annual cash inflows, so to get the incremental annual cash inflows, so incremental annual cash inflows. Incremental annual cash inflows. We normally take earnings before depreciation and the tax. Earnings before depreciation and the tax. Then we add depreciation multiplied by the tax rate, multiplied by depreciation, multiplied by the tax rate. So this formula we have used it before, remember? Yeah, so we use that because the question had already given you, what is meant to be. At the end of the 5 years, the new machine will be sold for shillings 250,000. So estimated profit before depreciation and tax. Estimated profit before the depreciation and the tax. Before the depreciation and the tax. So year 1, we take the new machine, we subtract the one for the existing machine. So when you check year 1, it is 260 for the new machine. For the existing machine, it is meant to be 120. So we minus to get the incremental. We minus in order to get the incremental. So this is now for year one. This is now for year one. So when you take 260,000 minus 120,000, it should give us how much? We get 140. So you take 140,000. Then 1 minus 0.3. Then we add. Depreciation for year one up to year three was how much? In the step that we have just finished, in the step number 2, incremental depreciation. So you take 130,000. Which 130 from year one to year three? Yeah. Multiplied by 0.3. Like that. That will be for year one. We do the same for year two. We do the same for year two. When it comes to year two, it is 280 minus 150. 280 minus 150. So when you take 280 minus 150, it should be how much? So 130 also 1 minus 0.3. Then also we add. So this is still 130,000 multiplied by 0. We go to year 3. When it comes to year 3, it is 250 minus 130. 250 minus 130. It's 250 minus 130. So 250 minus 130 is 120. Yes. Then you also do the same like that. So this was still 130,000. Remember depreciation from year one. We get the value for that. Then we go to year 4. So year 4, when you take 240 minus 145. So 95. But depreciation for year 4 and year 5, it was which year? 180,000. Also multiplied 0.3. Then we also go to year 4, year 5, sorry. So the one for year 5, it is also 270 minus 135. So 270 minus 135 will just remain 135. Will just remain 135. Also 1 minus 0.3. So this one was also 180 multiplied by 0.3. So we get those figures. So that should be your Roman letter 2 of the question. That should be your Roman letter 2 of the question. That is now meant to be the Roman letter 2 of the question. So that was meant to be our step number 3. So number 4, which is the same as the Roman letter 2. So when it comes to the Roman letter 3, they are asking that should the existing machine be replaced? So before we go that, there is the Roman letter 5. Roman letter 5, we get the incremental terminal benefit. We got the step number 5, where we come up with the incremental terminal benefit. Where we come up with the incremental terminal benefits. We get the incremental terminal benefits. We get the incremental terminal benefits. Get the incremental terminal benefits. So when it comes to the incremental terminal benefits, when it comes to the incremental terminal benefits, so it will be, we start the incremental salvage value. We start off with the incremental salvage value. Incremental salvage value. When it comes to the incremental salvage value, when it comes to the incremental salvage value, so there is the one that we calculated. How much was the incremental salvage value? So, 150,000. So, incremental salvage value. Yes. It was 150. It was 250 minus 100. Yes. Then we add changes in the working capital. We want to add the changes in the working capital. We are supposed to add changes in the working capital. So to get the changes in the working capital, we also calculated. It was also 150,000. And so you also add the 150,000. So when you add, you get the incremental. Then finally, now we advise. So when you advise, you simply convert the NPV. For the advice, we shall just calculate the net present value. So now for the advice, we simply compute the NPV as our step number 6. So NPV is supposed to be given by present value for the cash inflows minus the present value for the cash outflows. So to compute the NPV, it will be given by the present value of the cash inflows, we minus the present value of the cash outflows. So we start off with present value of the cash inflows. So there is the year, then cash flows, then present value interest factor, So the cost of capital is 13%. The cost of capital is 13% for each year, so that we get the present value. So this one, we go to year one. Go to year one. So cash flows for year one. You calculated, how much was that? Online, you give me the figures. Sorry? 147,000. 137. So online, you confirm. You remember we calculated the incremental annual cash outflow, inflow. So year two was how much? Year two, 130,000. Year three, 123. Year four, 125. How about year five? 148. So we take 148,500 plus what? The incremental salvage value. So terminal benefit, sorry. Incremental terminal benefit in the previous step that we have just done. It was 300,000. Yeah, so terminal benefit, we included in the last year of the economic life. We have done that under the net present value. So you add there the 300,000. So that we come up with which year? It is 400 and 100 and 400 and what? 48. 48, 500. So we check in the table. We check in the table what is 13%. Year one, year two, year three, year four, and year five. So we now check in the table. So when we check in the table, year one, it is 0.8850. 0.8850. Year two, it is meant to be 0.7831. 0.7831. Then year three, is it 0.6931? 0.6931. 0.6931. Year four is meant to be 0.6. 0.6133. Then also 0.5428. So you multiply so that you get present value for the cash inflows. Then you less present value for the cash outflow was our step number one. And remember, it was 919 310. So you will be subtracting 919 310. So that you get the end. So if it is positive, we advise them to replace. But if it is negative, we advise them not to replace. So is it positive or negative? It is negative. So the advice is that the existing machine should not be replaced. The existing machine should not be replaced as it will lead to a negative NPV. The existing machine should not be replaced as it will lead to a negative NPV. So I also want us to do another question, November 2017, question number 4, part B. November 2017, question number 4, part B. We now go to November 2017, question number 4, part B. 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 So that question for November 2017, question number 4, part B. Question number 4, part B. The question reads that Karimu Bottling Company is considering replacing one of the bottling machine with a more efficient one. The old machine has a current net value of 2.4 million with remaining useful life of 5 years. The old machine has an estimated resale value of 200,000 shillings at the end of its useful life. So existing machine current disposal value is estimated to be 1060. The new machine has a purchase price of 4.7 and an estimated useful life of 5 years. The machine is expected to have an estimated market value of 600,000 at the end of the 5 years. The machine is expected to economize on electric power usage, and a repair cost, which will save the company 920,000 each year. In addition, the new machine is expected to reduce the number of defective bottles, which will save an additional amount of 120,000 annually. The company's corporate tax rate is 30%, with a required rate of return of 12%. The company provides for depreciation on the straight-line basis. Assume capital gains are taxable. So now required, Roman letter 1, the initial net cash outflow. Roman letter 2, incremental net operating cash flows for years 1 up to year 5. Roman letter 3, the total terminal cash flows. Roman letter 4, using the net present value criteria, advise the management of Karimu Bottling Company whether or not to purchase the new machine. So we start off with part A, Roman letter 1, how to get the initial net cash outflow. That is the same as our step number 1, where we get the incremental cash outflow, where we come up with the incremental cash outflow, where we get the incremental cash outflow, where we get the incremental cash outflow. Where we get the incremental cash outflow. where we get the incremental cash outflow. The incremental cash outflow, where we can get the incremental incremental cash outflow. So to get the incremental cash outflow, we start off with the initial cost of the new asset. We start off with the initial cost. So when you check in that particular second paragraph, after existing machine current disposal value is estimated to be 1.06, the new machine has a purchase price of 4.7 and estimated useful life of 5 years. So we start with, so the initial cost of the new asset, initial cost of the new asset. So that figure has been given as 4.7 million. That figure has been given as 4.7 million. That figure has been given as 4.7 million. That's 4.7 million. So that's now the initial cost for the new machine. That is meant to be the initial cost of the new machine. So this question had no installation cost. Also, the question had no changes in the working capital. So changes in the working capital were not given. So that one will not apply. The installation cost is not there. Changes in the working capital is also not there. But they have said that existing machine has a current disposal. So we minus the current market value of the new asset, of the old asset. We less current market value of the old asset. Current market value of the old asset. So the current market value of the old asset was given. The 10.60. You can say existing machine current disposal value is estimated at how much? 10.60. It is meant to be 10.60 like that. So when you minus, you get the gross cash outflow. Get the gross. So those other details were not there in the question. That's why I'm avoiding them. Get the gross cash outflow. So this figure is how much? Okay. 36. Then we are supposed to add tax on the capital gain. We add the tax on capital gain. So to get the tax on the capital gain, we start with current market value of the old asset. Current market value of the old asset, which is meant to be 10.60. Then we should be able to less. The net book value of the old asset. We are supposed to less the net book value of the old asset. So net book value of the old asset was given. The net book value of the old asset was. So the second line, the old machine has a current net book value of 2.4 million. You can see the 2.4 million in the first paragraph. So this one will be a capital loss. We don't tax a capital loss. So we ignore that. So that one will be capital loss. We ignore the value so that we come up with the incremental. We get the incremental cash outflow. Get the incremental cash outflow. So we go now to the step number 2, where we compute the incremental depreciation per annum. Step number 2, we get the incremental depreciation per annum. So we come up with incremental depreciation per annum. Get the incremental depreciation per annum. Incremental depreciation per annum. We get the incremental depreciation per annum. So when it comes to incremental depreciation per annum, we start with the one for the new asset. Depreciation of the new asset. The new asset. So that one, we simply take the current, so we are given the 4.7 millions. 4.7 millions. We are supposed to less the salvage value. We check whether there was the salvage value in, whether there is the salvage value. So the new machine was purchased at a price of 4.7 and estimated useful life of 5 years. So the machine is expected to have an estimated market value of 600 at the end of the 5 years. So that's now the salvage value of the new machine, because they have said that the new machine has a purchase price of 4.7 and an estimated useful life of 5 years. The machine is expected to have an estimated market value of 600,000 at the end of the 5 years. So we minus 600,000. We minus the 600, which is the same as 0.6 million. So divide by the economic life, which is meant to be 5 years. We divide by the economic life, which is meant to be 5 years. So we less the one for the, we less the depreciation for the old asset. We less depreciation of the old asset. Depreciation of the old asset. So for the old asset, they had given you the net book value of 2.4 million. Net book value of 2.4 million. Then they had said that after the 2.4 million remaining useful life of 5 years, the old machine can estimated a resale of 200. But this question did not give you the salvage value for the old machine. What they gave you is that the old machine has an estimated resale. Sorry, they have given you the 200,000. Can you see the 200,000? Yeah, they have given us the 200,000. So that's the same as 0.2. So you also divide by 5 years. Also divide by 5 years. Also divide by 5 years. So that is now our step number 2. We got the step number 3. So step 3, we get the incremental salvage value. The step number 3, we simply come up with the incremental salvage value. So the step number 3, simply come up with the incremental salvage value. The incremental salvage value. Salvage value. So when it comes to the incremental salvage value, we start off with the salvage value of the new asset. We start off with the salvage value. The salvage value of the new asset. The salvage value of the new asset, which is 600,000 less the salvage value. Less the salvage value of the old asset minus the salvage value of the old asset, which is meant to be 200,000. Because we already have them left. So that one should give you around which figure? Then now we got the step number 4. Step 4, which is now the same as the step number 2. Incremental net operating cash flow. So we want now to get the incremental cash inflows. We now get the incremental cash inflows. We now come up with the incremental cash inflows. The incremental cash inflows. So incremental cash inflows. For us to get the incremental cash inflows. Incremental cash inflows. So this one you prepare the cash flow statement because there were no revenues. Like the first question we did, it is simply the savings the question has given you. When you check towards the end of the question, they say that the machine is expected to economize on the electric power usage and the repair costs. So we start the savings on the power and repairs. We start the savings. So it is the same as the first question we did. So savings on power and repairs. On power and repairs. Savings on the power and repairs. So savings on power and repairs. The amount there is 920,000. The amount is 920,000. Then apart from that, there was another item. There was savings on the defective bottles of 120,000. So we also add savings on the defective bottles. We add savings on the defective bottles. Savings on the defective bottles. So that savings on the defective bottles, it was 120,000. It was meant to be 120,000. So that we get the savings before depreciation and the tax. We get the savings before depreciation and the tax. We get the savings before depreciation and the tax. So 920 plus 120. 1040. Now we less incremental depreciation. We less depreciation per annum. So we calculated that incremental depreciation per annum. It was which figure? It was 60. Was it that big? Incremental depreciation per annum. Which was the one for the old asset minus the one for the new asset. So you added. It should be incremental depreciation should be 380. So that figure is 380. So 380. So that we get the savings before the tax. Savings before the tax. So savings before the tax, when you subtract, we are getting which figure? $600 and so 660. Then now we less the tax. Minus the tax. So 30% of 660. 30% of 660. Of the 660. To give us 198. 198. So that we get the savings after the tax. Savings after the tax. So savings after the tax will be which year? 462. 62,000. Then now we less. So we add back. The depreciation. We add back the depreciation. So it was depreciation was 380. So that's now your Roman letter 2. How to get the incremental annual cash inflows. Incremental cash. So that was your Roman letter 2. Now we got the Roman letter 3. Roman letter 3 is the same as the step number 5. The total terminal cash flows. 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 Total terminal cash flows. Total terminal cash flows. Total terminal cash flows. So to get the total terminal cash flows, when you want to get the total terminal cash flows, we simply start with the incremental salvage value. Incremental salvage value. So incremental salvage value. Incremental salvage value. You can see we calculated it was how much? The step number 3. 400. Yeah, so 400,000 We are supposed to add changes in the working capital, but it was not there. Changes in the working capital, which was not there. That figure is at 0. So to be able to give the 400,000. To be able to give the 400,000. So finally, now we got the Roman letter 4. Roman letter 4 is that using the NPV criteria, advise the management. So now we compute the NPV. NPV is the present value of the cash inflows. We minus the present value for the cash outflows. So we start off with present value for the cash inflows. So it will be annuity multiplied by present value interest factor for the annuity. So that cost of capital was meant to be, the cost of capital was given as 12%. So that will be 12% for the 5 years. 12% for the 5 years. So how much was that annual cash inflows? It was 800 and what? When you added back depreciation. So it is 842,000. 842,000. So in the table, 12% in year 5. 12% in year 5. So it is 3 point what in the annuity table? 3, the second table.
Yes, 3.604.
Yeah. Then also the terminal benefits. Also the terminal benefits. So this one, we use the first table, 12% in year 5. We use the first table, 12% in year 5. So it will be 400,000. In the 400,000. Then we multiply by 0.56974 in the first table, 12% in the first table. It should be 0.5. You can confirm it is 0.5 what? 674. So when you add them, they will give you present value for the cash inflows. Then you will be required to less present value for the cash outflows, which was our step number 1. Our step 1, we got 300 and what? 3,640,000. It was 3,640,000. So that you get the NPV. Obvious that NPV is negative. So when you compute, you minus the 3,640, you will get a negative NPV. You should be able to get a negative NPV. You should be able to get a negative NPV. So if it is negative, we advise them not to replace. The advice is that they should not replace the existing machine. They should not replace the existing machine as it gives a negative NPV. So I want us to stop there. When we meet, we shall do another 2 questions for the sake of those who are not there today. So we can stop there for now. We can stop there for now.